what is Forex trading? So by the end of this video, you will have a good understanding of what Forex trading is. More importantly, if you're a trader and have never been able to explain to someone what it is that you do, simply send them this video. Without further ado, grab a notebook and a pen. Let's jump straight into the video. The Forex market is the global market where currencies are bought and sold across the world. It is currently the most liquid market in the world. At the time of shooting this video, it is over $6 trillion traded a day in volume. On trading Forex, you get to match up currencies. So you'll match the euro against the dollar, you'll match the dollar against the yen, you'll match the pound against the yen, which is my favorite. But you'll also get to trade commodities such as gold versus the dollar, silver against the dollar, and so much more. The beauty of Forex is it gives you the opportunity to be involved with some of the big players in the world. From the likes of us retail traders, you have institutional players, central banks, companies, investors, and so much more. When matching up your currency pairs, there are going to be opportunities for you to match the most liquid pairs against those that aren't. You'll also have exotics, which are currencies that aren't as frequently trading, which will also mean there'll be a lot more volatility in the market. Volatility is often seen as a bad thing, but it's only a bad thing when your risk is not managed. So make sure if you're watching this right now and you're new to trading, risk management has to be at the forefront of everything that you're doing. Your main focus as a trader is buying a currency when it's weak and selling a currency when it is overvalued and a currency that shouldn't actually be there. This involves finding the underlying strength and weaknesses of currencies at those particular times. That is also known as fundamental analysis. Fundamental analysis is finding what actually drives those currency pairs. Technical analysis, on the other hand, is spotting trends and patterns on the charts for you to go ahead and take advantage of strength and weakness of one currency versus the other. When trading currencies, you are going to have what is known as the bid and the ask. This is when you're buying and selling those respective currencies, and the difference between those two prices is therefore known as the spread. And the spread, ladies and gentlemen, is the broker's bread and butter. That is how the broker, which is facilitating you on their platform, makes a profit. Depending on the account that you have, you may have a zero commission account with a higher spread when trading. And also, if you have a low spread, you may have a commission on every trade you place. So keep that in mind. The good thing about Forex is you can trade directly to the market, but you can also set limit orders on where you favor either selling a currency higher up or buying a currency lower down. That helps for people that don't have that much time to dedicate to the markets, but also more of a hands-free approach. Set your trade in and that's it. You can carry on with your day. So before we carry on with the video, to summarize, Forex trading is the selling and buying of currencies. As a trader, you are involved with some of the big players out there, such as institutional players, central banks, and so many more players. With a volume of over $6 trillion traded a day, there is going to be a lot of volatility throughout the day. That's where you as a trader can match up your majors, which are pairs that are traded a lot more frequently, which means there's more volume, less volatility, which there's a less chance of too much swings throughout the trading day. But there also are exotics which aren't traded as much. They may give you a bigger trade in the market, but there's going to be a lot more volatility, which can introduce a lot more risk. Also, to remind you, there is a bid and an ask. The difference between those two is the spread, and that's what you as a trader are paying every time you put a trade onto the market. There are two types of analysis. There is technical analysis and there is fundamental analysis. Fundamental analysis is finding what actually moves in a currency, why a currency is moving. You're looking at the data, you're looking at the growth, you're looking at retail sales, you're looking at wages, and so much more. And technical analysis is using technical patterns for you to go ahead and spot recurring patterns in the market to jump on the back of trends when a currency is either strengthening or weakening at that given time. But yeah, that's the summary for now. Let's carry on. So some of the most important things that I can mention in this video will be risk management and psychology. Risk management ensures that you are managing your money and you're managing your risk when being involved in the markets. Please remember, trading Forex involves high risk, and more than likely the account that you are trading with will have access to high leverage. Leverage, ladies and gentlemen, is how much buying power the broker is giving you for your account size. This is also known as notional value. If you have $1,000 account and you have a 500 to 1 leverage, this will give you buying power of so much more than your actual account size. So all that means you'll be able to bet bigger, which does introduce a lot more risk. And that goes into the second point of risk, and that is calculating your lot size. Please go ahead and make sure you use a lot size calculator when calculating your risk. Knowing how much you're going to lose on every single trade just ensures that security of not blowing up your whole account on one trade. So make sure you go ahead and check that out. Having a positive risk reward in markets ensures that you are allowing your edge to play out in markets. So what that means is if you're going to go ahead and risk 1, you need to at least be making 2 or 3 every single trade. That is something that I personally do on a daily basis. On a weekly basis is ensure that if I'm going to be risking 2% this week, I have to at least be trying to make 4-5% on that trading week. Some weeks are better than others, but I'll be speaking about that in further videos. There are different trading styles. There is scalping, there is intraday trading, there is swing trading, and there's position trading. The difference between all those 4 is the time that you actually hold the positions for. If you're scalping, you're going in for a few pips every single day. If you're intraday trading, you are trading throughout the day, but you are looking for slightly bigger moves. If you're swing trading, you're more than likely holding a trade for the whole week. And if you're position trading, you're holding the trade for multiple weeks, multiple months, capitalizing on a full swing in the markets. As much as I wouldn't recommend demo trading, I would suggest if you're completely new, open up a demo account, get used to the lot sizes, go ahead and figure out what it is that you're actually doing. Find some sort of consistency for at least 2 to 3 months before you apply live money to the market. However, live money to the market is the best teacher out there. It will teach you a lot about yourself. It will teach you a lot about your emotions. It'll also teach you a very crucial lesson on money management that everyone should undergo. But yeah, that's it for this video, folks. I hope you enjoyed this video. Feel free to share this with a friend, but also like, comment, and subscribe to the channel because I'm bringing a lot more content to the channel. But I hope you enjoyed this video. See you soon. Peace out.